Hello, and welcome to Connected with Latham, where we discuss ideas, legal developments, and business trends shaping the global economy. I'm Michelle Kelban, a partner in Latham & Watkins' New York office and global co-chair of the firm's real estate practice. In this episode, we discuss current trends and hot topics of the private equity real estate space in Europe. To dive into this, I'm joined by my fellow real estate private equity partners, Carsten Loll from our German office and Rafael Molina from the Madrid office. Carsten, Rafa, welcome. It's great to have you both here today.
Thank you, Michelle. Great to be here.
Pleasure to be here, Michelle.
Surging energy costs, historically high inflation, and rising interest rates have become a major concern for institutional real estate investors in Europe, which has led many to put a halt on their investment activity. Global transaction volumes fell 30% year over year during Q3 22, with Europe seeing the biggest drop of about 44%. How is all of this impacting the European real estate sector? Carsten?
Thanks, Michelle. It significantly impacted the market. We saw a drop in transactions basically by 30% in the last quarter, whilst the first 2 quarters of the year were strong. What we see now is basically a price discovery, a standstill in the market, and there's hardly a market because sellers and buyers don't find the right price. What we will see in my eyes is a pickup of the market once we have comparables, and I expect the comparables to be significantly lower. So official numbers show a decrease in prices by 5 to 10%. I expect it to be significantly higher in the area of 20 to 30%.
Rafa, how about you?
Thank you, Michelle. Thank you for asking. Well, it's a very interesting question because, volumes did drop in Spain in the last quarter of 2022, but the volume of investment in Spain in 2022, it was like 30-40% higher than 2021. The way I look at it is that we're going through a macro transition. We have enjoyed pretty low interest rate, pretty much free money for 10 years. And now as a result of inflation, interest rates are going up. And the expectation is that interest rates are going to remain around 2 to 4%. This obviously has a huge impact on values because cap rates have also gone up and nobody really knows where and when they will land and what the exit yield will be. But a fair assumption that I'm hearing from clients is that yields are 150 to 200 basis points higher than a year ago. As a result of this, the last half of last year was the worst ever in fundraising in Europe for real estate, but still, there is 80 billion of dry powder ready to be deployed. So there is plenty of money for real estate in Europe.
Let's move on to what we think is actually causing this market dislocation. Investors have been discussing if this is in fact a debt crisis. How would you respond to that, Rafa?
I think this crisis is different to the GFC. In my mind, the key features of the GFC were that it was caused by irresponsible lending to the real estate sector, in particular in Spain to resi developers, and the credit crunch that followed. Banks were not lending to anybody, not even lending to each other. And as a result, there was zero lending or very little lending for a number of years. And this is not the case now. This crisis is not caused by too much irresponsible lending, but rather by a drop in value caused by a sudden increase in interest rates. And this time around, the banks are in pretty good shape. They've never made so much money as a result of higher interest rates. So I think it's different to the global financial crisis. I don't know how I would characterize it, but it's like I would call it it's like a sudden drop in value type of crisis. So there is a number of investors that have undervalued properties in their balance sheet.
I totally agree. The difference to the global financial crisis in '08 is that there is strong demand on the tenant side, but also on the investment side. So it is a reflection in pricing, as you said, Rafa, that we will see because we justified the high price levels before with the low interest rates and they went up significantly. So it must have an impact on pricing. And as you said, we need to see where interest rates will land to be finally able to adjust pricing in the markets.
And Karsten, what you just said ties into my next question, which is what strategies are you seeing investors take to take advantage of the dislocation in the market?
Right. And for Germany, it's a unique situation. I think it's the first time in a decade, basically, that the market will, in my eyes, offer prices or price levels that are interesting for opportunistic investors. They have a lot of dry powder. They raised funds. They are flexible. They have discretionary money. So I think if we see prices going down, if we see a certain distress in the market, we still have this demand on the tenant side, be it in the office market for AAA offices or for logistics, then we have real chances there that you kind of buy at price levels that are attractive to kind of get you to the returns that you actually want to have as an opportunistic fund.
And Rafa, how about you? What are you seeing in Spain?
Well, in Spain, we are not seeing distress yet. We are seeing lower volumes, deal volumes, and we are seeing some instances of lack of liquidity. But I would say that at the moment, the market is a market for people who are able to buy with all equity, right? Given the lack of financing or the reservation of lenders to lend, we are seeing, sovereign wealth funds, pension funds taking advantage of opportunities. But again, not a huge volume of deals in the market. But I do think that as interest rates continue to be high, distress opportunities will come up and liquidity triggers will give rise to more opportunities.
Let's turn now to specific asset classes and what challenges and opportunities you're seeing. Rafa, in the office space, what challenges are you seeing, or do you think office is just the new ugly duckling after retail in Europe and Spain in particular?
I think the situation of offices in Europe is different to the situation of offices in the US. In Europe, people are mostly going back to the office to work. Perhaps London is an exception. And the vacancy rates that we are seeing in Europe have nothing to do with the vacancy rates that I understand you have in the US. So it continues to be an interesting asset class. The focus is more on tenant demand for energy efficient office buildings. So if there are good located buildings that can be improved, made energy efficient, those remain to be good opportunities, good investment opportunities in Europe.
So, Carsten, let's move on to logistics. This has been a hot asset class over the last few years. How do you see the current economic environment affecting logistics?
I think it's still a hot market. There's strong demand on the tenant side for logistics, so there's strong investment activities in the market as well. There's rental increases possible. You've seen it over the last years, and I'm very positive for the future as well. However, we've seen pressure on prices even in the logistics market, so cap rates went up significantly.
Rafa, let's turn to hospitality. Spain is known for its beautiful hotels. How has the hotel sector been performing, and how has deal flow been since the end of the pandemic?
So last year we had a good deal volume in the hospitality sector in Spain. And in terms of tourists coming to Spain, we had a pretty large number, not quite what we had in 2019, but pretty high. So, and hotels were able to increase rates, which compensated for the increased capex and employment costs. So the hospitality sector in Spain had a pretty good summer last year. Now, what is the expectation? I think the expectation is that it's going to be difficult that this year matches the previous year. So at some point, there will be some need for liquidity from hotel owners, and there will be some opportunities in the market.
Karsten, let's talk about the residential sector in Germany. How has the current economic situation impacted the build to rent strategy and the multifamily strategy in Germany?
It's a very good question. Thank you, Michelle. It's difficult. There's strong demand and there's a big lack of affordable housing in Germany. So we're lacking a couple of 100,000 units basically per year. There's 1 million refugees from the Ukraine in the country. Many of them will stay. So from that end, there's a strong demand as well. But at the same time, building costs went up significantly. So you basically cannot afford building the resi units that you would need at the rent levels that people would be able to pay for, or the state wants them to stay. Some of the large operators just stopped building, and I think there will be a political discussion now about rent levels. How can they be kept? Shouldn't they be kept? Or should the state now be involved into basically building affordable living, which I think the state has to do.
Thanks again to Carsten Loll and Rafael Molina for joining us today and giving us great insight into the European real estate market. It has been a pleasure having you both.
Thank you, Michelle.
A pleasure to be here, Michelle.
And thank you to our listeners for checking out this episode of our Connected with Latham podcast series. Stay tuned for more episodes coming soon, where we will cover other key topics and growth opportunities in the evolving real estate sector. You can subscribe and listen to new and archived episodes of Latham's podcast on lw.com, Apple Podcasts, Google Podcasts, Spotify, or wherever you get your podcasts. If you'd like more information about the topics in this podcast, please email us from links located in the show description. We hope you'll join us again next time.
This podcast is provided as a service of Latham & Watkins LLP. Listening to this podcast does not create an attorney-client relationship between you and Latham & Watkins LLP, and you should not send confidential information to Latham & Watkins LLP. While we make every effort to assure that the content of this podcast is accurate, comprehensive, and current, we do not warrant or guarantee any of those things. And you may not rely on this podcast as a substitute for legal research and/or consulting a qualified attorney. Listening to this podcast is not a substitute for engaging a lawyer to advise you on your individual needs. Should you require legal advice on the issues covered in this podcast, please consult a qualified attorney. Under New York's Code of Professional Responsibility, portions of this communication contain attorney advertising. Prior results do not guarantee a similar outcome. Results depend upon a variety of factors unique to each representation. Please direct all inquiries regarding the conduct of Latham & Watkins attorneys under the New York's disciplinary rules to Latham & Watkins LLP, 1271 Avenue of the Americas, New York, New York, 10020. Phone number 1-212-906-1200.